wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome to you, my family of wealth builders. This is episode 9, effing around and finding out why covered calls work. In the show notes of the prologue episode, I shared a link to 3 white papers that showed that covered calls outperform the buy and hold strategy in the long run. The bottom line is they work. But here is the rub. Most investors can't make them work. They say 95 or 99 or whatever % of retail traders lose money. For actual traders, it's probably true. And it's really mainly, honestly, because they don't put in the effort to learn. It's kind of their fault, really. With covered calls, it's a little different. It's probably more like 80% of investors don't outperform the market in the long run using covered calls. And maybe 30% of that 80% just screw it up so badly, they completely mess it up 6 ways to Sunday and underperform the market terribly. And, maybe another 30% just kind of don't do a good job and underperform a little bit. And maybe 20% come close. I think that adds up to 80%. Now, either way, these are not official numbers or anything. I would say anecdotally, that's probably about what my observation is, though. Covered calls, they're a little easier to do okay with than actual active trading of short-term options positions. But it's still not easy. But I believe that armed with the right knowledge and the right motivation, you can move mountains. You can do it. I know you can. Now, before jumping into the effing around part of this show and finding out today, well, I need your help. You can help grow the Wealth Building with Options community by doing 2 things. First, consider sharing this podcast with like-minded people. Word of mouth is so important. The more people who know about this show, the more our community grows. The best way to grow our community organically is just simply by telling more people about it. The second thing you can do is please leave a review on Apple Podcasts, Spotify, or whatever podcasting platform you listen on. This helps so much. It helps the algorithms push out the show to more people. If everyone could leave 1 review, I think we could make it to being one of the biggest options investing podcasts there is. And when you post a review, I'll return the favor. Here's what I'm going to do. When you leave a review on Apple Podcasts or Spotify or wherever you listen on, after you post your review, take a screenshot of it and go to either our social media or our Substack, follow us, and post the screenshot of the review. Then just leave the hashtag WBWO so we see it, and we'll send you my covered call strategy guide for free. The links to our social media and our Substack are all in the show notes. I thank you in advance, and I really appreciate your help growing the Wealth Building with Options community for you, for me, and for all of us. Okay, time for the effing around to begin. In order to really understand this idea of why covered calls work, well, it's important to understand a little better about how options in general work. Stock and futures, it's checkers. Options is chess. There are more moving pieces, and they each move differently. But this is why options are better. It's actually why options are easier to trade. And I know that sounds kind of like a contradiction, right? But I assure you, It's not. There's a guy from Chicago. Well, he used to be from Chicago until we had two back-to-back god awful mayors. I mean, the guy we have now is, well, all right, you probably don't care about that. But needless to say, this guy that I'm talking about from Chicago, well, he moved his whole business, one of the most profitable trading firms in the world, to Miami. Although, if you've ever been here in Chicago for a Chicago winter, you don't really need another excuse to skip town than that. But anyway, the person I'm talking about is Ken Griffin. Ken Griffin of Citadel. As legend has it, Ken Griffin was a college kid at Harvard, taking finance classes, and was learning about convertible bonds. He came to the realization that convertible bonds were just bonds with a built-in call option embedded in it. So like A equals B plus C, bond plus call equals convertible. So he started trading the arbitrage of this relationship in his dorm room. And when prices got out of whack among the three pieces of this puzzle, he'd buy the cheap part and sell the expensive part. And, well, the rest is history. This was an approach that no one ever put in the thought to figure out before. All the basic parts were apparently in textbooks mentioned in class, but he put in just a little extra brain power. And now you can go to the Kenneth and Ann Griffin wing of the Chicago Art Institute. When things are hard to figure out, the average person doesn't put in the time to figure them out. But those who do reap the reward. And it's kind of the same with options. There are just a few extra things you need to know to trade options above and beyond what you'd need to know to trade a stock. And once you know them, you can use them to your advantage to gain an extra edge over those people who didn't put in the time to learn these things. And guess what? Over the next 5 to 7 minutes or so, you're going to learn them. How about that, huh? Pretty good, right? Okay. So the first component of an options value is indeed directional, but it's a little different than the directional nature of a stock. And to be sure, the price of the underlying instrument, a lot of the times, is the most important influence on option values. Here's how it works. As we know, option prices are derived from the underlying stock, right? So the price of the option follows along with the price of the underlying stock or ETF or future or whatever. When the price of the underlying stock goes up, the value of the call listed on it will go up. When the price of the underlying stock goes down, the value of the call goes down. But this follow along movement doesn't happen in lockstep. The call moves some fractional amount of what the underlying moves. This directional value sensitivity of the option relative to the underlying stock is measured by what option traders call delta. It is a metric in the family of what we call the option Greeks. Delta can be thought of a few different ways. Now, the first way to think of delta is the rate of change of an option's value relative to a change in the underlying's price. It's stated in percentage terms, usually decimalized. So if the call has a 0.32 delta, that means its value changes 32% as much as the underlying stock price changes. If the stock rises by $1, the call value rises by 32 cents. If the stock falls by $1, the call falls by 32 cents. So this way to think about delta, to recap in plain English, delta is how much the option value changes relative to the underlying price change. The next way to think of it is in a high math way. Delta is the derivative of the graph of an option price on the vertical axis plotted against the stock price on the horizontal axis. So don't get too hung up on this one. The third way to think about delta is that it's the equivalent sensitivity of the option position compared to the number of shares that one would own if they own shares. So back to the same example. Let's say an option, a call, has a 0.32 delta, 32%. And because if the stock goes up by $1, you'd make $32, right? 32% of that dollar move times 100, you'd make $32 if it goes up $1 on that one call. Well, I mean, that's the same as if you owned 32 shares, right? If you own 32 shares and it goes up $1, you'd make $32, right? Make sense? And then finally, the fourth way to think about delta, it's often thought of as the likelihood of an option expiring in the money. This is what I call the trader's definition. It's not mathematically accurate as a definition and should only be used as a loose rule of thumb, but there's value in introducing this concept here, as it's discussed further throughout this entire podcast. So those are the four definitions, if you will, of delta, but for media purposes, let's focus on two of them. That delta is how much the option value changes relative to a move in the underlying price, one, and two, delta is the likelihood of an option expiring in the money. Okay? You remember those? That's going to take you through many episodes here. Other price influences may act in accordance with or as a counterbalance to the impact of delta on an option position. Time passing erodes options value, and they call this erosion or time decay. As each day passes, options become worth a little less. The option's time decay is measured by theta. Theta is measured in the same units as the option premium is stated. So if an option worth $2.80 today has a theta of 0.09, well, tomorrow the isolated effect of the theta would leave it to be worth $2.71, 9 cents less. So in a nutshell, theta measures how much time decay comes out of the option in one day, and it measures it right down to the penny, actually to the fraction of a penny. Each option represents the rights on 100 shares of the underlying. So the call, which at $2.80 is worth $280 of cash, so the 9 cent theta makes it worth $9 less the next day, so $271. Each of these option Greeks is an isolated price influence. Delta can make an option worth more or less, while theta has its separate effect. The next isolated value influence on an option is volatility. Investors new to the concept might find it abstract, but it's actually fairly simple. When there's demand, i.e. buying pressure, it forces the price of options, or anything really, to go up. And when there's supply, meaning people are selling, there's selling pressure, well, that's when prices go down. And it's always sort of a battle between the forces of supply versus the forces of demand, the buyers versus the sellers. So this valuation input is what I would say misfortunately called volatility. The units that volatility is expressed is annualized standard deviation. So it's a percent of the stock's price. When supply and demand forces cause implied volatility to change, the effect on option prices is measured by the Greek Vega. And those of you who are in fraternities or who are actually Greek, yes, I know it's not a Greek letter, but that's what they call it, Vega. Vega is measured in option premium in much the same way that Theta is. Imagine there's an option trading at $5.60 with the Vega of 0.15, so that's 15 cents. Now let's imagine there's a lot of buying pressure. Goldman Sachs comes in and they're buying thousands and thousands of these options. And consequently, as a result of that buying pressure, the liquidity providers, the market makers, react and they raise their implied volatility input by 1 percentage point, we'll say, from 24% to 25%. The option, which has a 15-cent Vega, will increase in value 15 cents from $5.60 to $5.75. If instead some other firm, JP Morgan or whoever, comes in and sells thousands of options, if implied volatility decreases by 1 percentage point as a result of said selling pressure, the option loses 15 cents. And of course, that 15 cents of option premium actually represents $15 of actual cash. Mathematicians worked to create a mathematical model that valued options for many, many years. But there was always some mysterious piece of the puzzle missing. The mystery was solved by Fisher Black and Myron Scholes, and that was done in 1973. They added an input that they simply called volatility, and the Black-Scholes model became the celebrated first generally accepted options pricing model. Though there is apparently some question as to whether Edward Thorpe beat them to it, but just chose not to publish his findings so that he could, just trade it himself and not tell other people about it, which frankly is probably what I would do. But I cannot prove or disprove that. I will leave that to someone else to prove or disprove. Now, in practice, traders call this volatility input, I said it was like misfortunately called volatility. Traders call this volatility input implied volatility when they're actually trading with it. Because the original rationale for this volatility input being added into the valuation model is it's theoretically thought of as the future expected volatility of the underlying stock that is implied by option prices. All right, let me just say that one more time again. The volatility input into an options pricing model is theoretically thought of as the future expected volatility of the underlying stock that is implied by the option prices. Well, I say theoretically indeed. The wisdom of crowds theory suggests that if a lot of people are all guessing at the same expectation, the collective guess of the crowd overall is probably going to be pretty accurate. Well, there are a lot of traders trading in the market at any given time. And in my experience, I'd say they're always wrong, at least to some degree. We call the mechanism of auction markets on which our securities trade the price discovery process. And every now and then we have what's called a correction, a market correction. It's as if the wise crowd is acknowledging, well, yeah, we got it wrong. Let's correct it, right? A stock may go up and down every day for seemingly no fundamental or rational reason, except that day, some big trader decided to buy or sell it. And it may come back the next day because some different trader decided to sell or buy it. Clearly, no stock is correctly valued at every given moment in time, or probably at any given moment in time for that matter. The market is not what is called strong form efficient in price discovery. And this is where I have to give a little bit of a woe is me because, I'm a guy who grew up in Chicago, the Chicago area, and I'll tell you what, Chicago hot dogs, best hot dogs there are. Well, I don't know. Those of you who are from the Detroit area and have the Coney dogs, I mean, those, they might be a little better than Chicago dogs. Chicago pizza, I kind of like New York pizza a little better, but Chicago's a close second, right? But I have some pride in Chicago. And all these economic theories, a lot of them all started at the University of Chicago, where incidentally my daughter goes. I should be defending the University of Chicago. But the professors there, the really smart guys, and they are really smart guys, but they did come up with this idea called the efficient market theory. And what that means is that traders and investors are so good at pricing the market and buying and selling it when new information is added to the market that the price of the market equals what the market is worth, the value of the market at all given times. But you know what? That's really just a bunch of baloney. It's really not true at all. And the same goes for the options market. But that can seem a little more abstract. Because there are a handful of compelling price influences on options, it's really hard, by which I actually mean completely impossible, to look at an options trading price on your screen, on your brokerage platform, and say, oh yeah, this one's overpriced. So options traders need to normalize the price of the option by holding all but one pricing influence constant and use only implied volatility to measure an option's relative value. Implied volatility is the metric in determining whether an option is overpriced or underpriced. And this does relate somewhat to the actual volatility of the underlying stock. In somewhat oversimplified terms, the theory is that if a trader buys a pure volatility position, which we'll just introduce this here. You don't have to get hung up on it. If you don't get this mastered the first time, don't worry about it. All right. If a trader buys a pure volatility position, which is called a straddle, which is when a trader buys a call and a put on the same underlying stock in the same expiration, and they both have the same strike. So they buy this straddle, right? Same strike, same expiration, buying a call and a put. So basically the idea, if it goes up, you make money. If it goes down, you make money. Okay. If they were to buy that straddle at what option traders call fair value, which is some price above the bid that you would see in the market, but below the ask or the offer that you see in the market. So right in the middle, we call it fair value or theoretical value because it's, where it must be valued at. If somebody wants to buy it because they think it's too cheap below it, and somebody wants to sell it because they think it's too expensive above it, it must be worth in the middle, right? Okay. So if a trader buys a straddle at fair value, and if the underlying stock experiences going forward an annualized standard deviation identical to the implied volatility level at which the trader bought the straddle between now and the expiration of the options, the trade should break even. So I know this being a podcast, it might be a little hard to intellectualize this. If I bought, and the strike doesn't matter. If I bought a straddle and both of the options were a 30 implied volatility, and between now and expiration, the stock actually traded with an annualized standard deviation of 30, I should break even. Statistically on average. It's not a universally true statement, but now if the stock experiences more volatility than 30, the volatility level that I bought both of those options, that would mean that the market undervalued implied volatility in hindsight, right? If I bought a 30 volatility and between now and expiration, the stock actually experiences a 40% annualized standard deviation, well, then that straddle should have been worth more, right? The straddle is going to profit then because there is more volatility than otherwise. If the stock experiences lower volatility, which means the implied volatility is overvalued in hindsight, right? I bought a 30 volatility on the straddle and it only traded at an annualized standard deviation of 20. Well, then I would lose money on the straddle. Now, please note, for all the mathematicians and professors out there, this is what I would call true, but requires several mathematical caveats and explanations. In my other book, Trading Option Greeks, I share a more accurate interpretation of this concept. And anybody who wants to get really, really good at the option Greeks, Trading Option Greeks is the first book that I wrote. Now, it's been my experience and the experience of everyone whose opinion I respect on option valuation that, like in stock market valuation, options implied volatility is always wrong. And that is measurable too. There exists what is called the risk premium in the options market, or at least there has been since the crash of 1987. The risk premium is the observation that in the long run, options have been overvalued relative to the actual realized volatility. That's the volatility realized by the underlying stock or ETF, like we were just talking about. In other words, options have been overall overpriced. Aha! Now we've got something to hang our hats on, a true edge. This is the main reason why covered calls work. They work because they are likely to add value, statistically likely. They work because the price one can sell them is greater than the value they add. This is meaningful and a profound statement. And it's true for any option selling position. The price one can sell an option is greater than its value. That's just such a pretty sentence, isn't it? I didn't want to clutter it up with caveats and details, but, well, there are some of those. When teaching classes on option trading, I always start a sentence like that out with, statistically overall, options are always overvalued. I can certainly go and find 10 stocks that have overvalued implied volatility options right now at whatever moment you're listening to this podcast. I mean, as long as the market's open. But even if the market's closed, they can still probably do it because the prices will settle too high. But since October of 1987, options have had what is called the risk premium. The risk premium is an extra small little bit that option traders are willing to pay And option sellers will only sell and accept selling it if the risk premium is present above and beyond what the option is worth. So there's kind of a lot to untangle there. First, we're measuring worth in terms of volatility, in terms of implied volatility, and future realized volatility. The option can and will make or lose money on delta. It'll change in price lower as time passes as a result of theta. But if we hold all that constant, the normalized price of an option is its volatility. Next, how do we know if an option is overpriced? Well, we can use the benefit of hindsight, and we can use skilled forecasting as well. Fortunately, implied volatility, which is normalized option prices, the value of an option with everything else held constant, and then we use implied volatility as the one factor to change, right? So that's a normalized option price. Implied volatility and realized volatility, which is the actual volatility that occurred in the stock, are stated in the same units, annualized standard deviation. If we look back at where implied volatility was and what realized volatility ended up being in that time, well, statistically overall, we'd see that more often than not, implied volatility was higher than it should have been. Skilled volatility analysts arguably are able to quantify what the implied volatility for an option should be based on the available information of current realized volatility, planned volatility events, which is a thing, like data announcements, like earnings reports or non-farm payrolls. We call them planned volatility events. So we take the realized volatility of the planned volatility events and compare it with what implied volatility actually is now. They can then identify whether implied volatility is overpriced or underpriced. And they'll usually find it's overpriced, but not always. That's why I always use that little caveat, statistically overall, because that's a thing. Now, finally, so let me back up a second. So all the stuff that we talked about in the last episode, the kind of warm and fuzzy things that make covered calls look pretty good on the surface and, kind of are pretty good, but it's all balanced out by the option pricing model. Well, this isn't. This is taking that option pricing model and valuing the option and selling when it's overvalued only. And it's not always overvalued. Sometimes it's undervalued, and that's when we use option buying strategies. But, so you might think, well, hold on, Dan, then we don't want to sell covered calls all the time. They're not always good. And in a way, that's true. But keep your mind open here for one more reason why covered calls work. It's because of repetition. Or I guess rather, the way to make them work is to repeat them over and over again. It's not about collecting one covered call premium. It's never about this one trade right now. That's not where the power is. The power is in selling them serially. If there is risk premium statistically overall, but not always, and sometimes there's more risk premium than usual. And sometimes there's negative risk premium and options are too cheap. But you average that out. If you always have a covered call on a particular stock, over the long run, you would capture the average risk premium for the entire time you'd overwritten the stock. You had covered calls on. Okay? This is like, let me distill this. If this thing is always worth X, and on average, I can sell it for X times 0.02, 2% more than X. Sometimes a little more, sometimes a little less. Sometimes I actually lose. Sometimes I actually do great. But overall, in the long run, I can sell it for, let's say, 2% more. If I just close my eyes and sell it all the time and not even think about the value compared to the price, in the long run, I'm going to win. It's an edge. That is the whole magic of covered calls. That sums up everything in this entire podcast, everything in the entire book that I'm in the process of writing. For this segment, we're going to once again be joined by the same fellow who joined us last week, Vice President of Market Intelligence at CBOE Global Markets, Henry Schwartz. Henry, welcome back.
Thank you, Dan. I'm happy to be back. I love talking options all day long, so anytime you need me.
So this episode was all about, really, in my opinion, why covered calls work. And that to me is the risk premium and just the repetitiveness, so that you're always capturing that risk premium, at least average overall. Sometimes you're capturing more than normal, sometimes less than normal. What do you have to say about the risk premium? How do you define it? Why does it exist? What are your thoughts?
It's a very interesting and very timely question, right? I've started in the business in the late 1980s, and options were definitely not very popular. But the firm, but all of the kind of professionals that were in the business knew that selling options had some built-in edge. Right. There's plenty of phrasing, when in doubt, palms out. That was like, you want to be a seller. You basically, although options were considered risky, right? They have convexity to them. They can go from 50 cents to $50. More people lost money by owning options and basically bleeding out on the time decay, the theta, than people got blown up being short. Now, people did get blown up being short too, every once in a while, but it's kind of like, as a professional, if you're a good risk manager, you can handle those really tough times, and consistently you would definitely lean short premium. And that question is like, well, why? That basically tells you the options must be slightly mispriced if you're able to make money selling them. The answer is there's a structural kind of inefficiency, which is that, what I just said, options they're not nearly as widely traded as stocks. They're a lot more popular than they used to be, but it's still kind of a niche. And it's easier to buy an option than sell an option, right? And even just in terms of getting brokerage level approval, right? Level one is generally buying options. Considered safer. It's actually, we have arguments or conversations with the community sometimes to say, like, I don't know if it's actually safer to buy an option, because that can be a kind of a losing game most of the time. But still, nobody blows up an account, meaning loses more than they even had, being long an option. That's why it's kind of evolved that more people buy options than sell options in the retail world. That kind of results in an overpricing. Okay, there's another reason, which is that if you are short options, it takes a lot of margin to do so, right? So if you're naked short an option, so you just don't have as many people that can sell options, and therefore they tend to trade a little rich. The last reason is that there's a little bit of an insurance premium built in, right? The puts are insurance, the stock insurance, right? Whether it's an index put or a single stock put. People overpay for insurance because you're happy to overpay for insurance, right? You need the insurance. You might know this thing's really only worth $1, but I need to sleep at night. I'm going to pay $1.05 for this, and I'm not going to worry about that because it's achieving my goals. It does work the same way on the call side. You don't have as many sellers. Technically, the risk of being short a naked call is infinite, right? So think about that. There are people that, you might look at some calls and go, wow, the stock's at 100 and the 180 strike call is trading at $1. I don't think that stock's going to get to 180. I'm going to sell that call and just pocket the $1. Well, even if you're an account that has enough money to do that, I mentioned sleeping at night. Like, well, what happens if they get taken out, in a $300 a share deal, and your dollar credit now becomes a, $180 loser or something? So options tend to trade a little bit expensive in general. You see that if you plot, the realized volatility against the implied volatility, right? The implied volatility is higher than realized in general, with a few exceptions, right? If when you have a market volatility shock like COVID came around, and options that had been trading with a implied volatility of 15 or 20 might have actually realized 60 vol, right? And so that means those options were mispriced. They did not know about the potential for some sort of a big crisis to come along. But that's absolutely the exception, right? It happens, well, we say a couple times in your career. Realistically, it probably happens a couple times a year. But the rest of the time, the options are generally a little better of a sale than a buy. So, that structural situation means that people tend to do okay selling options. It comes down to risk management, right? Like, how do you sell options? How many do you sell? What do what's really your strategy? I mean, and I think that's what you're into, which is like, what's my plan here, right? Like, what instrument did I select, and what am I going to do if the stock really moves? Okay, so to me, it's kind of always that, like you make a plan, then you execute, and don't waver.
Yep. So, as far as this risk premium goes, like, we know it's there. You can't really touch it, but you can maybe kind of quantify it. I mean, is that something that you and the other super smart folks at CBOE track, and like you have like some idea of what it is and how much it fluctuates over time?
We do look at, we tend to look at the volatility risk premium in the indexes more than in single stocks, because the indexes are kind of our sweet spot. We list everything, but the vol risk premium tends to average around 3 or 4 points of volatility over time. Okay, and I mean, you have to realize, if it's, even whether you're talking about an index or a stock, like there's a feedback mechanism, which is, if the volatility is too low, then anybody that sells it is going to get hurt. They're not going to sell it anymore. The volatility is going to kind of rise back up. And like I said, volatility the implied vol tends to trade higher than the realized, just because fundamentally it kind of needs to, right? Because for the reasons that I said. So I think in general, you're consistently looking at, between 3, 4, 5, 6, 7 points. And single stocks are really trickier, right? Because you have to think about things like earnings, right? And like, I like the concept of, everybody talks about volatility and like, well, close to close volatility, but there's a lot of nuance to that. Like, well, wait, close to close, well, do you want to include earnings, or do you want to kick earnings out of this? Because what if you did a trade that started the day after earnings and you exited it the day before earnings? Then, maybe earnings itself, the impact of the earnings day on the realized volatility, can be really significant. A lot of these stocks, will move 10 or 15% on earnings. Everybody knows they're going to move 10 or 15% on earnings. But if you're not in the stock for that earnings day, and you're not in the options on the stock either, then the volatility you're talking about experiencing is pretty different. So, when it comes to single stocks, there's a lot more nuance to how you treat that, right? Certain stocks move 1 or 2% on earnings, and other ones move 10 times that. And so it can make a big difference. And, I think it has to work into a trading plan as well, because, it may be priced into the options, but it's certainly going to add a lot of complexity to the whole process.
Yeah. And that risk premium is just, it's really important. To me, it's the quantifiable edge. But, like the stuff we talked about the last time, it's important too. I don't know if the options pricing model actually justifies that it's an edge or not. So, like, how important would you rank the existence of the risk premium in covered calls for investors? Like, is that the most important thing, or?
No, I wish it was. It's definitely not the whole story. In fact, you can sell an option at 40 implied vol and have the underlying realized 20 implied vol over the life of the option, and you can still get killed, right? So it is not simply a matter of saying, well, my implied vol was 40, it's realized 20 in the past, and it realized 30 this month, so I made money. But there's a path dependency to the whole thing. There's also a lot of human kind of issues, right? So, if you happen to sell it the 2 days before it just trudges higher, the market, if a stock goes up 1% every single day consistently, then, the volatility is zero, right? Because there's no variation to how much it moves. It's just, but it's also going to hurt you in terms of your trade. So you have gap moves, especially in single stocks. News comes out, and and how people trade through that matters. So it's definitely the volatility risk premium is I guess to me it's kind of like it's a tailwind. It helps. It is not going to guarantee you make money. That I think has a lot to do with stock selection, strike selection, paying attention to the premium you're selling, the slippage that you're dealing with, and really executing on your plan. If you say you're going to close out a trade when the premium gets down to, below a dime or below, or you've collected 90% of your premium or whatever your kind of rule set is, and then you don't do that one day because you're on vacation when the stock dipped, and then the next day the stock, it's shot higher and you missed your chance, then, you got to be like, well, wait a second. If I had followed my plan, I would have done great. And instead I got hurt.
Mm-hmm. Yeah, there's a lot to this. There's a lot to it. I guess that's why we'll be doing this podcast still for a whole nother year. So
to me, that's what's awesome about it, though, is that the smartest people still haven't quite mastered this market. I mean, there's geniuses, there's hedge funds with the smartest minds and the biggest wallets in terms of technology and systems, and still they get hurt every once in a while because it's not something that it's a market, meaning it does weird things. You can fight about value and speculation and everything else, and that's for options professionals, right, who live and breathe this stuff, they're a tool. They let you express a view, and then they let you adjust risk, and very efficiently. That's to me that's the best thing that's happened in forever, is the fact that it's no longer so painful to get in and get out of a trade. When I started in the business, you not only did you have to kind of get everything right, but you had to cross some really nasty bid offer spread to get in and to get out. And so, there's so many situations where you could sell calls, stock could go down, time could pass, and then you go back to buy them, and you end up paying the same price you sold them at, purely because the bid offer was so wide that, in a way you're kind of getting squeezed by the market, by the lack of liquidity. And now that we're seeing, so many participants and 60 million contracts a day so far in March, which is insane, and very, very efficient liquidity providers, right, who really they're still able to make money off of you, but we're talking on a 2-cent spread instead of on a 20-cent spread. And that for the customer is awesome.
Henry, that's all the time we have. Thank you so much for sharing your decades of wisdom with our audience again, and maybe we'll try and twist your arm and get you back sometime.
Okay, great, Dan. Thank you very much.
Thank you. And that about wraps it up for this show. But before you go, help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. When you do, you'll be the first to hear episode 10, which is a very special episode with a very special guest. And I'm going to keep this one a surprise. But one thing I can tell you is this person has some great stuff to talk about, and you're going to love it. So that said, friends, I will see you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.